What critics get wrong about reverse mortgages by my man Wade Pfau. We're going to talk about this article. I think I might have done, I don't know if I ever talked about this article before. I don't know. But I have talked about reverse mortgages, and we're going to talk about it now. Sorry about the unkempt look. Literally rolled out of the sack about 2 hours. Right now it's about 8 o'clock in the morning. Yeah, about 8 o'clock, maybe 7:50. I've been up since 5:30, and I've been wanting to read this article to you and go over it before I had a chance to freshen up and change into something more comfortable and take the razor to my chin and then even comb my hair. So if you're offended by the fashion, lack of fashion that we do here, I'm probably not the right video place for you, that's for sure, because fashion is not a top priority to me, as you can tell by my just my outfits. A t-shirt, unkempt, and even really, that's a nice thing about having short hair. You comb your hair, you take your 4 fingers plus your thumb, you go like this, comb hair, done. All right, so let's go into this. On a side note, I'm interviewing Wade on Friday. So at Friday, I can't remember what time, so he'll be on the podcast. So if you have questions about reverse mortgages you want me to ask Wade, please put them in the show notes because I'll be happy to ask him. I cannot wait to get Wade on the podcast, the Josh Scanlon podcast. And again, Wade had written a book. Let's see. He had written a book, Reverse Mortgages. How to use reverse mortgages to secure your retirement. I'll put that in the show notes with the Amazon link. So if you click on the link and buy the book, your old buddy Josh gets paid big bucks. All right, so this is Dateline April 15th. Oh, how ironic, April 15th. From Advisor Perspectives, I'm a huge fan of the folks at Advisor Perspectives. A guy named Joe Tomlinson I came across in Advisor Perspectives, and actually I'm doing some other research. Stanford Center for Longevity, in which Wade and Joe Tomlinson are on, and they got 136. It's in there someplace. Anyway, they got a 136-page document through Stanford that's on there, which I'll be reading here shortly. I've read it, but I'll go over it with you guys shortly. But this will almost be like the cliff notes in some regard of that study. Press coverage around reverse mortgages has grown more positive in recent years as new research has helped to explain how they can improve the prospects of an overall retirement income plan. So if I may, I remember probably about 2013 or 14, all of a sudden out of nowhere, Wade was, and I've always followed Wade, I've always respected him, and then all of a sudden out of nowhere, there's a group I'm somewhat familiar with, maybe through the Financial Planning Association. I can't remember, but anyway, I was getting these emails say, "Hey, Wade Pfau talks about reverse mortgages and the benefits of reverse mortgages." I was like, "What is?" I was like, "Is Wade, has he sold his soul?" Because it's like, from our perspectives in the financial realm, reverse mortgages were scams, as we quote Dave Ramsey. And I said, "I can't believe Wade, because Wade's a solid researcher." I was like, "Huh? It's nuts, man." It'd be like Tom Brady playing for the freaking Giants. I was like, this is just weird. So anyway, that was my background of not of Wade, but of seeing Wade go on the reverse mortgage, basically, barnstorming. I was like, this is just odd to me. But anyway, but I've come to be a true believer myself. It's amazing what evidence and thorough research can do without browbeating people. It's kind of interesting. Yeah, take that for other areas of your life. Don't browbeat. Talk. Open up your mind. Debate and be curious. All right. However, a lingering question remains about the cost of reverse mortgages. Costs can be high, which leaves people wondering how their benefits can be justified. In isolation, reverse mortgages can look expensive, and one might question the motivations of those researchers who argue that reverse mortgages can add value. As I was like, why is Wade doing this? But reverse mortgages should not be viewed in isolation. They are a piece of a larger puzzle that retirees are trying to solve. Reverse mortgage costs can be offset by gains elsewhere in the overall financial plan. To show this, I'll create an example to illustrate how a reverse mortgage, by protecting the investment portfolio, creates a net positive result despite its costs. The power of the reverse mortgage to help preserve an investment portfolio in retirement can be viewed in a number of ways. For instance, a reverse mortgage could be used to refinance a traditional mortgage to avoid making monthly payments. I completely agree with that. It could be used to build a bridge to support the delay of Social Security benefits without taking excess distributions from an investment portfolio. Completely agree with that. It can be used to coordinate distributions from an investment portfolio to avoid creating greater pressure on the portfolio when markets are bleak. Completely agree with that. I'll show an example in the last point as to where the most of the research about reverse mortgages have become, starting with Barry and Stephen Sachs' seminal article in reverse mortgages in 2012, and that's in the Journal for Financial Planning. Anyway, so just which you can't get. I don't know if you. Well, anyway, let's see. Can you get this guy? Can't remember if you can or not. Let's see. But so what we're going to talk about in this article is the reverse mortgage could be used to coordinate distributions from an investment portfolio to avoid creating pressure on the portfolio when markets are bleak. So let's see if we can get. Yeah, that's weird. Okay, so I'm not able to get that. So anyway. That's odd. I'm not a member of Financial Planning Association anymore, but sometimes you can still get their stuff. Sometimes you can't. Anyway, all right, so let's go into what Wade's research is. For example, I'll assume a 65-year-old retiree who has $1 million in an IRA and a home worth $200,000. So we got $1 million in an IRA, home value $200,000. The home is fully paid off. She uses a 50-50 allocation, rebalanced annually and divided between the S&P 500 and intermediate-term U.S. government bonds. I'll use the historical returns from 1966 to 1995. This is a valuable series of data to use because it was the years that gave us the 4% rule of thumb for retirement spending. Over those years, one could withdraw just 4.03% of their retirement date investment assets and sustain that level of spending with inflation, adjusted for inflation for 30 years. All right, bear with me. So just because that is a safe withdrawal rate, we're going to look at this because it gets dicey. Just remember, that's a 4.038% rule of thumb for the 4% rule. Did it work as advertised? We'll show you. The idea is to treat the retiree as a retiring at present and facing current rules. Oh, I'll also assume the home's value grows at the Case-Shiller Home Price Index, which happened over that time frame. But we test the retirement with a market return sequence with historical data. On the reverse mortgage side, because the LIBOR rates was at the London Interbank Exchange rate, I forgot what it was. The LIBOR rates are not available for this period. I will approximate them using 1-year constant maturity treasury rates and a 10-year treasury bond yields. The historical data for stocks, bonds, and inflation are provided by Morningstar. The 1-year treasury rates are from the Federal Reserve, and the Case-Shiller, he put Shiller first, Case-Shiller home price returns and the 10-year treasury yields are from Robert Shiller's website. All right, so we got a lot going on there, but just I'll show you here in the spreadsheet. In the first scenario, the retiree does not use a reverse mortgage. She takes $40,388 distribution from her $1 million IRA in the first year because that's a 4.038% 4% rule. And she adjusts those distributions for inflation in subsequent years over her 30-year retirement period. As this was a historical sequence that triggered the 4% rule, her IRA balance is reduced to $396 after basically nothing when she dies. So if she lived 1 year beyond 30 years, she has no money left. Her home value has grown to be $992,000 over that time frame. Let me get my trusty calculator. Boy, I always put it way over here. All right. Oops. So here's my trusty calculator. So remember, she started with $200,000 was her home value, and she ends with what, 992,666. She did that for 30 years. 992,666. So her home grew at 5.48% a year over those 30 years. That's the home value. So when she so here we go. So here we got, she's 65. That corresponds with year 66, 1966. She's 66. That's 1967, whatnot. She has an IRA balance of $1 million and a home value of $200,000. So her total net worth is $1.2 million. She takes $40,388. That's a 4.038% rule from her IRA. So the home grows at whatever the rate was at that year, according to Case-Shiller, But her IRA value dropped by, let's see, her IRA value dropped 1 million minus the amount she took out, which is 40,388, and then whatever return. So 1966, we had a negative year, so our IRA balance dropped. 1967, we had a positive year. 1968, so you can see that. So basically, what happens here is if we take the home value, which is just growing at that, whatever the Case-Shiller rate was, but at the end of the 30 years, it averaged 5.48, and we take real returns of her portfolio while she's taking distributions, when she hits right here as the end of 1974. So she started the beginning of 1973 with 1.16 million, and she's living happy as a clam. She ends 1974 though with 851,000. That's a pretty significant decline. That's 116 minus 851 divided by 11. That's a 23% reduction in her, in her portfolio. That's a pretty significant deal, man. So that's tough. That's gonna be a tough road to hoe. We'll see. But she does it until she hits, when she's 90 years old, she has $396 left in her account. That's it. So she says, I retired and I was able to bounce that last check. But she still had almost $1 million in her home. So, but that did nothing for her from a cash flow perspective. But she retired positive, or she died. In scenario 2, though, she uses a reverse mortgage. In particular, at age 74, right here, at age 74, at 8, when the market fell to right here. So the market fell to 851 at the end of age when she's 73, and she goes, man, I can't have that happen again. So I'm going to stop taking money from the portfolio, and I'm going to take it from the reverse mortgage. All right, so in particular, at age 74, which corresponds to January 1975, the retiree opens a reverse mortgage to cover age 74 spending. Her reasoning is that in the previous 2 years, the stock market dropped 15 and 26% respectively. And her IRA balance is down to 851,000, which is 15% from her initial level. With inflation, her age 74 IRA distribution will be $65,000, which is 7.7% of the remaining portfolio balance. So let's go back here. And when she's 64, she has to take 60, or not 64. When she's 74, she's going to have to take 65,000 from the portfolio. 65,781 from a portfolio. Was it 96, or is it going to be? No, 1 second. From this right here. So she has $851,000, but she's got to take the following year $65,000, which is 7.7%. And we know 7.7% isn't likely to survive. That's a pretty dicey scenario, but that's what we're doing now. She does survive, as history will show. She will survive, but barely. She has $300 left to her name. All right, so she's like, yeah, I'm not so sure I want to do that, because 7.7% is getting to be on the high side. And it'd be nice to provide some relief for the investment portfolio during this time. Wade says he did not model RMDs, required minimum distribution, but if she does not have other assets outside the IRA, what we could focus on, she could take her RMD and immediately reinvest into a taxable account to keep the stock holdings intact. I completely agree. So now her home is worth $307,000 as she finishes her 73rd year. Her reverse mortgage will be based on the 10-year Treasury at 7.5% at that time, along with a 0.5% each and every year mortgage premium and a lender's margin of 2.5%. The loan balance growth is based on the 0.5% mortgage premium plus the lender's margin and the variable 1-year Treasury rate. That's the loan balance. That's essentially the debt. The full retail fees to set up the reverse mortgage include a $5,000 loan origination fee, $6,147 upfront mortgage insurance premiums, and $2,500 for closing costs, appraisal, stupid title work, and all that. The total closing costs are $13,721, which will surely create a sticker shock, but it will be financed into the loan balance. As for spending, because reverse mortgage dollars are proceeds from a loan, they are not taxable like her IRA distributions. Thus, assuming a 22% marginal tax rate, she needs only $51,000 from the reverse mortgage to cover her age 74 spending, since the rest of the IRA distribution would be used to pay the taxes. With fees, her total reverse mortgage spending in that $51,000 she needs is $65,000 in that year. So here we go. So we're just going back here and we're stopping. We're arresting that year's distribution from the IRA because she's like, I can't afford another down year. I got to give the portfolio some relief. So all factors including, because reverse mortgage, you don't have to pay taxes on it. So she has to take out. She can take out less from the. She's essentially not spending as much because she doesn't need the taxes. So in this case, with a $51,000 to save her about basically $3,000 of taxes, she has what's that? And plus the closing costs, the origination fee, and all that is going to cost a total of $65,000 when all said and done for that first year. Now she's still going to have to take required distributions, so people get all wrapped around the axle on that. What happens to RMD? Wade already made a point about that. She said she can take it out, pay the tax, and put the money into a taxable account, so it's still there. Anyway, so what you see here is now she has $65,000 in reverse mortgage. That's what she took out. Her IRA balance grew to $1.043 million. Her house is worth $324,000, and now after the first year, the loan balance is $71,852 because the loan balance is based on what we talked about. It's going to be based on the 1 year Treasury. The loan balance growth is based on 1%, 0.5% mortgage premium, 2.5% lender's margin, and the variable 1 year Treasury rate. That will be the loan balance year over year. And if you remember your history, the variable 1 year Treasury rates back then were extraordinarily high. It's crazy, and I'll show you what that means at the end of the day. So the $65,000 grew to $71,000. It grew to $78,000 the following year, $84,000, and 10. Look at that. So 5 years in, 4 years in, she's up to $94,000 of the loan balance. Then the following year, 107, and we're talking 10% growth. $10,000 growth, $13,000 growth, $16,000 growth, $26,000. Look at that. But our portfolio is also growing too. All right, so that's the interesting thing. So while the reverse mortgage is growing significantly, the portfolio is growing well more to compensate for that, even after distributions. And what happens now that she has money left over to survive until 1982. Now the benefit of the huge market returns are just, it's freaking taking off like a rocket ship. So at the end of the day, when she dies at 30 years later, her inflated adjusted reduction is $189,000. Remember, she started with $40,000 30 years previous, but inflation, because this is a hugely inflationary time, she has to pull $189,000 from her portfolio. The portfolio at this point is worth $817,000. All right, so whereas before it was basically zeroed out, now it's $817,000. Her home is still worth $992,000. That hasn't changed, but now she has a $633,000 debt against it. All right, so the $633,000 debt subtract from the $992,000 home value, so she has $360,000 still in equity in her home. So her total net worth is $1.176 million, whereas before is just the value of the home at $992,000. That's a pretty big deal, and she had the lack of concern about the markets getting killed right in front of her very eyes. So now she has money left over. We'll talk about that in just a second. So Wade says, by sourcing the age of 74 retirement distribution from the reverse mortgage, the portfolio was protected from further decline at this key point in retirement. Rather than entering a downward spiral that left the portfolio depleted by age 95, the portfolio was able to cover, and $817,000 remained at the end of the retirement horizon. The portfolio balance is $817,000 larger in the reverse mortgage scenario too, and this portfolio gain has been a key benefit overlooked by those saying reverse mortgages are too expensive, because we actually put the reverse mortgage fees in here. In fact, Wade even did a service. He made even the highest fees, the origination fees that you could pay. I mean, we're talking a 5% origination fee, and I'd argue there's no reason you have to pay that. Meanwhile, the reverse mortgage loan balance does grow substantially throughout retirement. The loan balance grows to $633,000, which is nearly 10 times as large as the proceeds used. This is where opponents of reverse mortgages would step in and say they're too expensive. However, money is fungible, and we need to assess the household's overall situation. Our retiree's net worth in the IRA balance plus the home balance less the loan balance is $1.176 million, which is almost $200,000 larger than the net worth scenario without the reverse mortgage. And that's the key. the heirs wish to keep the home, they could repay the loan balance and still have $183,000 more left over as their windfall. Again, those who are only doing partial analysis will focus on the reverse mortgage costs and conclude that they're just too expensive. But even after repaying the loan balance, the net legacy value is still almost $200,000 more. All right, so I want to talk about some of the comments. So basically, what Wade doesn't say is he does say, and I'd say, okay, so let's just say that the heirs they inherit this $817,000 and it's an IRA, and we're just going to say that they're going to pay 25% taxes on that, just to make it simple. In that case, they're only going to inherit $612,000 net taxes plus the $360,000 in the net of the reverse mortgage home value. So that's net of the home value minus reverse mortgage. So they'll inherit $972,000 after taxes, whereas here they inherit $992,000. Now, again, that's, I mean, you could say because there's no taxes due on the home, it'll be sold at a step-up basis. All right, so that's $20,000. So some might say, and people do, but you're not taking into consideration the taxes. Okay, but again, I'm just worried about Ms. Jones. All right, Ms. Jones, we want to make sure she doesn't run out of money. And again, I'm just saying that heirs inherit with 25%. They might inherit it less. Either way, it's a wash. Secondly, if we start the reverse mortgage balance at $65,000 and we take our trusty calculator, 65,030, and we use that as a present value, no payments, we do it for 30 years, and we have a reverse mortgage balance of 633,784 at the end. What is it's costing us 7.88% a year in cost in terms of the growth of the mortgage. So again, 65,000 roughly is our present value. 30 years is our payment, is our number of years in which the reverse mortgage loan grows. The net value at the end of the 30 years, 784,000. 784,000, 30 years, and compute interest rate. Yeah, it's almost 8% a year. All right, so that means it's doubling every 9 years. Stinks, but that's the benefit of the negatives of the reverse mortgage, that we're still coming out ahead. No matter how you slices and dices, we're coming out ahead. So let's read some of the comments, because I always find the critics in some regard. I mean, sometimes the critics are pretty good. Sometimes I think they're a little bit odd. So let's talk about this here. So this guy says, having been in the business for over 40 years, I'm a bit uncomfortable with several assumptions here. First is that housing prices go up systematically over time with positive returns. He talks about his own situation where his house hasn't recovered. Second is called required minimum distribution, not optimized minimum distribution. The article says the RMD is sourced from the reverse mortgage. Taxpayers do not get to source RMDs from things like mortgages or annuities or taxable accounts. He calculated the RMD based on her prior year value at $851,000. Therefore, she would have required for a distribution of almost $36,000 in that year. So this still might work, but she has to take the RMD. She has to take the RMD, but it doesn't mean it has to be spent. I mean, yes, she has to take the RMD of $36,000 and pay roughly $3,000 in taxes. But the remaining $33,000 can be reinvested. In fact, that would just add to the amount of money that is left for the kids tax free. So, all right. So this guy says, Mark says, given current stock market valuations and interest rates, retired investors are staring down the barrel of a sequence return risk. Yeah. If we, in a way, reverse mortgage provides similar protection to a portfolio as a trend screen. It's costly up front, but the returns you earn on the money not withdrawn from the portfolio during down periods. Remember, your best returns coming after worst returns seem more than make up for the right. Okay. Then this guy says, we added mortgage oversight and origination to our practice, not as a revenue generator. I don't understand why you got to say, well, who cares if it's a revenue generator, but as a guard against poor mortgage deals. Our objection, aside from the cost of reverse mortgages, is the inflexibility versus other available options like HELOCs, which typically cost little or nothing. Our main objection is it guarantees a systematic destruction of principal. It is opting for an easy way out versus innumerable other choices, including family loans when necessary. After 40 years of practice, we can count on the fingers of our hands the number of clients who have diminishing asset basis. Yes, tomorrow's 87-year-old couple has 33 years as one with diminishing assets, including the HELOC we paid off last year. All right, so I just my thing is That's just I chuckle. So this is what I said back in April. I always chuckle at the folks who offer HELOC as an alternative to the HECM. Good luck getting a HELOC with an income stream of Social Security. No bank's going to underwrite you. Why? Because your debt to income ratio will be through the roof. But Josh, I have a 1.4 million in an IRA. Yep, you think the bank cares? They can't go after that asset in a creditor claim. Secondly, I always laugh at those Dave Ramsey, who claims the reverse mortgage that put grandma out of her home. And I say, try not paying your property taxes even if you have no debt. See how long the county allows you to stay at your home. And this guy, in my experience, mortgage lenders have no problem extending credit based on IRA distributions as a source of income. However, none of my clients has tried. So in his experience, mortgage lenders have no problem extending credit based on IRA distributions as a source of income. However, none of my clients have tried to actually qualify for a HELOC based on IRA income. If the client were to get the HELOC at age 74, then pay it off when the market recovered, it could be much lower than the reverse mortgage. All right, well, okay. And then this guy says, we've never had a problem legitimately qualifying income. Admittedly, we do not use HELOCs that frequently, but often involved other family. Okay, so again, and then he's often involving other family members in providing funds alternative. Simply put, when there are other options available, they appear to be both cheaper and more flexible. The downside is it takes much more time and dialogue to come up with a solution versus the HECM. I mean, do you really want to get your family involved in this? And so both these guys, the naysayers against my thing about getting home equity lines of credits, they say in their experience, but then they readily admit they haven't done it. You see what I'm saying? Where I've done it. I was in the bank. I'm telling you right now. The bank doesn't, I mean, they might look at your $35,000 of IRA distributions as a portion of your ability to pay the HELOC line of credit, but then I'll share with you how it works. So both these guys argue against reverse mortgage, make an argument against a product that they both readily admit they haven't used, but in theory it works, and that's the problem here. So I say HELOC line of credit, $100,000. You need to be able to afford 1 to 1.5% of the line amount to get underwritten with a debt to income ratio of no more than 40% max. So which would mean you need free cash flow of $1,000 and $1.5 a month to qualify. Doesn't matter the actual line amount used. It's your line amount for which they underwrite you on. All right, so going back to both these guys who says they can use RMDs from your IRA. Let's just say you have $850,000 in an IRA and you have RMD. We'll just say, I don't know, divide that by 23. You're going to have $37,000 of RMDs. We'll just say that's $3,000 a month. You may, if that's your only debt, you may be able to use that to get a home equity line of credit. But if you have any other debt, it's not going to happen because the fact they're going to look at $1,000 or $1,500 a month against a $100,000 home equity line of credit. Could you lower the home equity line of credit? Sure, absolutely. Are there other alternatives to home equity line of credit? Sure. In terms of you don't have to take the $100,000, but to just say the home equity line of credit is a good solution it's not looking at reality. It's just not. And on top of that, you still got to pay it back. That's another mortgage. And then this guy says HELOCs, Julio Lopez Brito, HELOCs are more flexible. They can be canceled, reduced, or frozen at the lender's whim. Just wait until the next housing crisis. I 100% unequivocally could not agree with that. We all saw that in 2007, 8, and 9. HECMs are expensive. What's the premium for a non-recourse loan? Ask people that had a HELOC on top of an upside-down mortgage in 2008. I 100% agree. As been pointed out already, try to qualify for a HELOC with no earned income. What premium would you be willing to pay? Then he says, just skip a couple payments to see how flexible the lender is. Whoever Julio, I got to look this guy up. I could not agree more. Okay, so now we got Aaron. It makes a good point. Scenario 2 leaves $817,000 to the heirs in an IRA, assuming a 22% federal tax bracket and 8% state bracket. The net inheritance work out to be less than scenario 1. That's true, but I highly suspect. I guess you could use say an 8% state tax bracket if you're going to take the whole thing out at one time. Regardless of the net inheritance, I find the most valuable. I agree with that. I agree. If it's an IRA and you're leaving more, it is going to be taxed as IRD, income with respect to decedent. I completely agree with Aaron's take here. I don't think it's a deal breaker at all. In fact, it means almost zero to me. But I get it. It's good thinking. When my clients ask about using savings to pay down low interest rate mortgages, I tell them that in If they are hungry in the future, they have money in the bank to buy food. If they sink all their cash into their home and they are hungry, they can't eat their house. Well, you could with a reverse mortgage. When HECM is paid, reverse mortgages is paid back, heirs estate would be able to take accumulated mortgage tax and interest deduction. Huh, really? I did not know that. But I like this best. From a diversification point of view, this is, in my opinion, this is the second point. This is a second slicing and dicing that makes a home equity line or the home equity conversion mortgage the benefit. Original position, 16% home, 84% investment portfolio. End position, scenario 1, 100% home, no investment portfolio. Scenario 2, 30% home, 70% investment portfolio. That right there is, I couldn't agree more. I think that's fantastic. So anyway, big fan. I got to find out who this guy is, Julio Brito. I love what he's talking about. Obviously, he's worked in other businesses other than just investments, and that's good stuff. So that's my man Wade. So like I said, be ready for my interview with him next on Friday. And if you have questions you want me to ask him, throw them my way, and I'll be happy to bring them forward. So don't forget to smash, and we'll see you next time.